So I think a lot of it is a technology mismatch. It's the speed mismatch between transactions and settlements. And so for most, so before the telegraph was invented, technology was mostly about, we got better at mining, we got better at production. We could make all the shells we want and therefore devalue shell money. We could make all of the tobacco we want and devalue tobacco money. Eventually, we settled on gold and silver because those are the commodities that are very hard to increase the supply of quickly. And so most technology had that kind of feature.
In this discussion, Lyn Alden highlights a historical technology mismatch in the world of finance. Before the invention of the telegraph, advancements focused on tangible commodities like gold and silver for settlements. The evolution of banking and encryption techniques further abstracted transactions, leading to a 150-year gap where financial systems became increasingly abstracted and financialized. Alden notes the current challenge of a speed mismatch between transaction and settlement processes, impacting global payments. While modern technologies offer solutions, such as distributed ledgers, their adoption is still in its early stages. Central banks, commercial banks, and politicians leverage this mismatch for arbitrage, affecting individuals globally. The interview emphasizes the need for innovations to address this issue and improve the efficiency of global financial transactions.
The second layer of technology we were working on is banking or various types of bills of exchange, ways to send transactions more quickly, either by having complicated ledger techniques or even analog encryption. How do you make a note that promises something that can't be forged or is hard to forge, for example? And we don't think of things like paper as technology, but back then they were. The ability to go from papyrus to paper is technology. The ability to bind paper into books instead of scrolls is a technology. The printing press is a technology, and those analog encryption techniques are a technology. And they were enabled banking. They enabled more efficient use of precious metals. But of course, you started to get abstraction and counterparty risk. But it was still modern. But when we invented the telegraph in the 1830s, and then specifically when it was deployed throughout the 1860s later at a very wide level, we could now send money instantly, globally, but physical gold, of course, is very slow. And so the mismatch between transaction speeds, which are now based on credit and abstraction, versus settlement speeds were huge. And so the world just became way more abstracted, way more financialized. And we've been in this 150-year gap where that's been the case. What's interesting is that some of these modern technologies allow for a distributed ledger where you can you can update the ledger in ways that are not reliant on credit. So you can do actually fast settlement speeds. And that's a new thing, and it's being tested by the market, it's being explored. But until we got to that point, which is still too small to really matter in the grand scheme of things, but basically that's the problem, is that we've been in this technology mismatch. And central banks, commercial banks, and politicians are able to arbitrage that abstraction. They can dilute everyone. They can keep people kind of locked in financial borders. Like, again, if you're in Nigeria, you're in this monetary environment. The money supply is going up by, I don't know the number, 15% a year. And it's hard for you to navigate around that. And so until fairly recently, there wasn't that many options, and that's the problem. Well, and the way that works, it's funny because you think it should be instantaneous, and in some domestic ledgers, it is instantaneous. No. The problem is when you interface different systems together, now you're speaking, it's like two languages that have to bridge each other. And so we have a series of correspondent banks. It goes through central banks. It goes through all these things. So that rules out global micropayments. It rules out fast payments. It makes payments expensive. It makes, especially small payments. If you're sending $10,000 internationally, it's a fairly low cost. But if you're sending $200 internationally, you're probably paying very high fees. I think the World Bank estimated that the average remittance fee was 6%. So the people who can least afford it are paying the highest amount. And it's an area that's not had a lot of disruption yet, that I think is in the years ahead going to be heavily disrupted. Well, so a lot of them they get to charge 3% on merchants, for example. They have very powerful network effects, and they're basically a bank overlay, right? So they're not really separate payment channels. They're helping banks communicate more effectively.
In this next discussion, Lyn Alden delves into the dynamics of fintech overlays on the traditional banking system emphasizing their role in facilitating more efficient communication among banks. Despite advancements, the reduction in remittance costs remains gradual, prompting Alden to question why, in 2023, the process isn't closer to being virtually free. Alden highlights real-world examples, like an Egyptian physician storing US dollars under his mattress due to local currency instability. Discussing gold, Alden recognizes its role as a reserve asset, but points out its limitations in speed. She explores the potential of technologies like Bitcoin and gold-based stablecoins to provide alternatives for global transactions, envisioning a future where diverse forms of money can coexist and compete more naturally.
I think it's a good example because most of what we think of as fintech, so whether it's older fintech like credit cards or newer fintech, most of this is an overlay on top of the banking system. All they're doing is finding ways to make banks talk to each other more efficiently. And that helps. It does reduce the cost. And we've seen remittance costs, for example, are going down, but it's going down from a very high level, and it's going down slowly, and it's not really, it should be virtually free in the year 2023. But there's even more egregious cases of that. For example, I know a physician in Egypt, a close friend. He stacks American cash dollars that he buys in the gray market under his mattress. That's his part of his savings in year 2023 because the local currency loses value too quickly. And this is not a unique. This is throughout the world. This kind of thing happens. And so both in terms of unit of account as well as international transfers, it's an area that has not been disrupted in a way that software has disrupted a lot of other things. But these are very powerful network effects. Many times they're state-backed network effects, and so they take a lot longer and more disruption to start really making inroads with. So I think it's primarily a reserve asset. The problem with gold is it's just not fast enough. And so in order to send it long distances, we have to basically abstract it. We have to put claims on top of it, and that gives a recipe for corruption, severing those claims, governments controlling the custodian, and then therefore deciding who gets those claims. I think so a lot of people hold gold when they're concerned about the stability of the financial system, right? I think in the future it might be the case where you hold gold because you're not sure about the stability of the internet. For example, something like Bitcoin, stable coins, all of our commerce really relies on a reliable internet. But if you're in a world where your internet gets severed from the rest of the world, or you're without internet for periods of time, there's still, I think, a desire for physical holdings of things. It might not be the thing you turn to on a regular basis, but it's like it's your reserve. I think that's where gold, and also some of these technologies can accelerate gold. I mean, for example, there are gold-based stablecoins that can allow. I could send someone a gold payment over a QR code on a video call, or if they send me an email and say, "Here's my address," and I can send that to them. It goes around there. It could be a graphic designer in Nigeria. I could pay her in Bitcoin, dollar stable coins, gold stable coins, whatever she prefers as her unit. We can find a way to have me pay her. And so it's just a world of money is able to compete more naturally.
In today's insightful discussion, Lyn Alden sheds light on the historical technology mismatch in finance, emphasizing the gap between transaction speed and settlement processes. From the evolution of banking to the current challenges in global payments, Alden explores the impact of fintech overlays on traditional systems and the gradual reduction in remittance costs. She delves into the intricate world of gold and its limitations in the fast-paced digital era. Alden envisions a future where technologies like Bitcoin and gold-based stablecoins offer alternatives for efficient and secure global transactions. As we wrap up this engaging conversation, we encourage you to reflect on the evolving landscape of finance and the potential disruptions on the horizon. If you found this discussion valuable, don't forget to subscribe, and share your thoughts in the comments below.